Hi, everyone. This is Seth Miller, Executive Director of the Innocence Project of Florida, and we have a very informative conversation for you today. I'm pleased to be here with attorney Joleen Searles. She's a lawyer at Shutts Bowen and based in Sarasota, Florida. And Joleen focuses her practice on complex estate planning, trust and estate administration, settlement and probate, high net worth planning, as well as federal gifts, federal state gifts, generation skipping, transfer, tax planning. Joleen also teaches continuing education seminars for financial advisors and attorneys regarding estate planning, wealth preservation, estate settlement, and relaying the latest changes in the law impacting estates and taxes. So, Joleen, I'm so pleased that you're here with us for this conversation so you can help me and our supporters to better understand how they may be able to leverage their retirement to make tax advantage charitable gifts to nonprofit organizations, other charitable endeavors, including the Innocence Project of Florida. So, welcome here today.
Thank you so much for having me, and thank you for letting me speak about this. It really is one of my favorite topics, and I feel like not enough people understand all of the great things that you can do using retirement plans in, conjunction with your charitable planning. So this is going to be great. I appreciate being here.
Great. So let's get right into it. So, Jolene, many people, me included, are building retirement accounts through our employer or through traditional or Roth IRAs or other investment vehicles. And, most people are building those retirement savings, which are going to provide them their primary vehicle for income once they retire. However, for the lucky ones, those folks may have accumulated a lot more wealth during their working years and in their retirement accounts, such that when they retire, they may not need, access to that retirement account to fund their standard of living upon retirement. So, for that second set of individuals, can you explain the rules around withdrawing portions of those retirement funds annually, even if they don't need it?
Sure. And you're exactly right. A lot of people will set up retirement plans and they max out while they're working. I'm going to gift the maximum amount. Ideally, it's been invested well, so it grows and it continues to get bigger. And sometimes people will need to break into their IRA, for example. And there are some exceptions where if you take it before age 59 and a half, like if you adopt a child, you're able to pull it out without a penalty. But otherwise, you have to wait till age 59 and a half to be able to take it out without incurring a penalty. Now, once you turn, and this age has changed multiple times. So it used to be 70 and a half, now it's 73. And then I think for those born in, I want to say it's 1960, it's 75, you are required to take out what's called a required minimum distribution. And what that is they're saying, we're not going to let this sit there and continue to grow tax deferred until you pass away. So when you get to the age where we think you need to start taking it, then we take your life expectancy, and they have all these tables that change, every couple of years based on the life expectancy calculations. But they may say, we expect you to live for another 40 years. So year one, you're going to have to take 1/40th of this amount out. And that is required. You can't not take it. If you don't take it, you pay a penalty of, I think it's up to 25%. So it's a really hefty penalty. Well, when you take that money out, for most IRAs, 401ks, all of that. So I'm not counting like a Roth IRA in here because that's a horse of a different color. But for most of your retirement plans, when you take that money out, you pay income tax on it because when you put it in,
Mhm.
it wasn't part of your income. You get a tax deduction essentially for putting it in. So it grows in that account and gets bigger and bigger, but it's tax deferred. So when you take it out, and some of those RMDs can be a lot. You may have $100,000 RMD or a $200,000 RMD, depending on how large your IRA has grown. And when you take that out, that is treated as income to you, that you have to pay income tax on. For some people, it bumps them up into a different tax bracket. So maybe I'm here, but now I take my RMD and it
Yeah.
bumps me up to the next level. So it can be, it's a nice thing to have that nest egg sitting there, but it can have some unintended tax consequences for sure.
Right. So that can be a pretty big surprise for someone when
A
they get to
huge
retirement,
surprise.
when they're doing their taxes and they're like, holy moly, I owe a lot of money.
Yes, exactly.
And so for our higher net worth individuals who may not need that
Yeah.
amount of money that's required to be taken out or required to be distributed every year, what can they do then to avoid that taxation, that surprise that comes along with the required minimum distribution?
Absolutely. So I have a lot of clients, for example, who are very charitably inclined. And the mistake that they make is they take out that RMD. So now it comes into them as income. And then at the end of the year, they say, okay, what charities do I want to give to? So I want to give to the Innocence Project of Florida. I want to give to my church. I want to give to my favorite local animal shelter. And so they make those gifts, but this money has now already come into them as income. And although they're getting charitable deductions, it's not as good. And this year they changed some of the charitable deduction rules to make it a little bit more difficult to maximize the charitable deductions that you can take. But if you give it directly from your IRA, this is a wonderful technique. It's called for short a QCD, a qualified charitable deduction. And what happens is instead of me pulling that required minimum distribution, the RMD, out of my IRA, I say, I just want to direct that money to the Innocence Project of Florida. And it goes directly from if I have mine at, say, Schwab. If I have my account at Schwab, Schwab sends it directly to the Innocence Project of Florida. It never comes to me, I never touch it. But when I file my tax return, I'm able to say, yes, I took my required minimum distribution, but I don't have to report that as income. So as long as it goes directly from the IRA custodian to the charitable organization, it flows through. It never comes in as income to me. It doesn't bump me up to the next tax level and then I have to take the deductions, but it qualifies as me taking that. Now there is a limit. I think it's 111,000. That changes each year. So this year it's 111,000. So if my required minimum distribution say was $100,000 and I say just send it all to the Innocence Project of Florida, then that's great. It goes directly there. I've met my RMD requirement. I am good to go. Now say that it was 150. I could still send all of that there, but the additional $39,000 would be treated as income to me. So if I go over that 111,000, I still do have to recognize that as income, or again, maybe I say, let's have the 111 go there. I'll have to take the additional part out. How do I still want to give it to them? But that difference would be income. But if you are under that amount, it is such a smart way to do things, and it really does help. If you were to ask your CPA, can you run the numbers for me if I take it and then contribute it versus if I just contribute it directly, you will see it's going to be a big difference.
Right, because when you make a after like if I could just get money from my
Yeah,
income and I give money to a charity, which I do, those
yeah.
deductions are not dollar for dollar. It's not a tax credit.
That's exactly right. And then it depends on, were they securities and were they, long-term gain, short-term gain. They look at all the things. What percentage of your AGI were they? We may
Right,
not allow the whole charitable deduction.
right, right, right.
Yeah.
Well, that's an incredible tool that folks can
Oh,
use.
it is wonderful. And the one thing that the caveat with that is it has to go to 501(c)(3) charities. So you cannot use this to go into your donor advised fund. You can't use it to go into your private foundation. It has to go to a 501(c)(3) charity, which fortunately you guys are. So
We
it
are.
works out well for you.
That's great. And it strikes me that there might be other similar strategies a donor could take to use charitable giving to reduce the tax implications related to their IRA or other retirement vehicles. Like, for example, let's say you want to, well, either someone is going to inherit an
Yeah.
IRA at someone's death, or maybe in your life, you want to make sure you mitigate the tax consequences of a beneficiary inheriting your IRA. What are some of the issues with that?
Great question. So, a lot of my clients are charitably inclined. And when we sit down to do their estate plans, they list out these are all the organizations that I want to leave money to. And okay, I want to leave, X amount to the Innocence Project of Florida, Y amount to my church, Z amount to my local animal shelter. And that's great. But if I build that into your trust, for example, then this is money that they're getting from your trust, which is good. But if I use the IRA instead, so the mistake people make is I'm going to leave my IRA to my kids. I'm going to name the charitable beneficiaries in my trust. Well, if that IRA goes to charities upon death, there are no income taxes paid.
Oh,
If they go to your kids, they're paying income tax on that. And so if I've got $1 million IRA and I want to make $1 million worth of gifts to charitable organizations, if I do that through the trust, the charities will get $1 million. If I do it through the IRA, the charities get $1 million. But if I do it through the trust and the kids are getting the IRA, maybe now the kids only get $600,000, $700,000 because they're paying income taxes on that money they get. Whereas if I leave them the million in the trust and the charitable organizations a million in the IRA, both of them get the full million. So I have a lot of clients that will say, let me just do all my charitable planning with my IRA. The other nice thing that people like is sometimes things change. Maybe you come across a new charitable organization that you love. It's a lot cheaper and cost effective for you to change your beneficiary designations. You're just doing that with your financial advisor. You're not paying a lawyer like me to make changes and amendments to your trust. So it's a really easy way to adjust your charitable giving. The other big thing that we've seen is the laws with IRAs have changed recently. So when I first started practicing a million years ago, first of all, we had an exemption. It was like 650,000. It was a very low estate tax exemption, and anything over that was taxed. And a lot of people did have more charitable inclination because of that. But back then, you could leave an IRA to beneficiaries and they could stretch it out over their lifetime. So you might leave $1 million IRA to your grandchildren, and those grandchildren would stretch that out over 85 years. And by the time they had finally taken everything out of it, they had gotten like $13 million. So the tax deferred growth was huge. We would run the calculations, it was astronomical. Now, the new rule that was passed with the Secure Act is they have, unless they fall into a very special category, which is a small group of people, they have a 10-year period that you've got to cash that out. So again, if I've got $1 million IRA and they've got to take that over 10 years, they're taking roughly $100,000. So I'm bumping up their income tax bracket by $100,000 of all income that's being taken over a 10-year period.
it's a
So
big tax
another
hit.
reason, exactly. So it is a huge tax hit to them. So whether people say, again, this is why I want to leave the IRA to charities and provide my trust to my beneficiaries, or there is a great strategy that estate planning attorneys use all the time that gives us the best of both worlds. And this is setting up a charitable remainder trust. And so what you do is you leave your IRA to this charitable remainder trust. So it all goes into this pot. And now that pot is invested. And you set that up for, again, maybe my grandchildren or my children, whoever I want to leave that to. But I have this trust last, and they get, say, 5% a year for the rest of their lives. There's no 10-year period. So they can essentially stretch that out for their entire lives. We know they're getting that 5% amount per year or 6%, whatever you set that amount at. So look at it like they're getting an annuity. They are paying income tax on it when it comes out, but they're not in a 10-year period where they're paying huge chunks of income tax. Plus, ideally, that money's being invested, it's growing. So if I'm taking 5% out, but it's getting a 10% return, each year that 5% is going to get bigger and bigger and bigger. And so what you do is you stretch it out for the beneficiary's lifetime, and then you say when they pass away, and now they've gotten that huge benefit for their lives, whatever's left goes to charity. The great thing about it is, first of all, the beneficiaries end up getting significantly more because they get that tax deferred stretch. And the second thing is the charity ends up getting a lot more. And if you had just left it to the beneficiaries, there would have been none going to the charity because it would have all gone to Uncle Sam paying taxes. So this, you kind of get the best of both worlds. The beneficiaries get more, the charity gets the money on the back end, you're saving taxes. Everybody comes out a winner on that. So it's one of my favorite strategies and one of the ways that we're kind of circumventing this 10-year cash out period.
These are things that we would not know if we didn't talk to an expert like you, Joleen. So, thank you so much for sharing your expertise with me and with our supporters. And, for those of you who are watching this, who are in your early to mid 70s and, want to leverage your retirement to invest in the Innocence Project of Florida's work to free the wrongfully convicted and help them rebuild their lives in freedom, directing your annual RMD to the Innocence Project of Florida is a great way to help, or using some of these other strategies that Joleen mentioned to us. It's just a really great way to help us fulfill our mission. So for more information about how you can do so, you can contact our Director of Development, Jessica Bivens, who can assist you with making such a gift. Joleen, thank you so much for providing us this really important information. And thank you to all of our generous supporters who are watching this for your commitment to freedom, justice, and truth. Thank you all, and see you
Thank you.
later. Thank you,
Thank you
Joleen.
so much for having me, and thank you for the amazing work that you all do. It really is a fantastic organization, and you are changing lives. So I cannot encourage your supporters or people who may not be supporters but should be. Please look at this organization. It is a fantastic organization. Take advantage of these great tax benefits.
Thank you so
Thank
much,
you.
Joleen. Thank you guys for
Thank
being
you
with us
all.
today.
Bye bye.